Right, lads and ladies, back into it. Today we're looking at Fibonacci and equilibrium. They kind of work hand in hand, but they work hand in hand. What the Fibonacci is, it is a sequence. Where's my cursor? It is a sequence. The Fibonacci is a tool that traders use to identify potential areas where price of an asset might reverse or stall during a trend. It's based on the Fibonacci sequence, which is a series of numbers where each number is a sum of the two preceding numbers. While the mathematical sequence itself is interesting, what matters more in trading is how we use the specific levels derived from this sequence. When applied to price movements, the Fibonacci tool helps us to find retracement levels. That's important. It helps us to find retracement levels. These are price points where an asset may pull back before continuing in its original direction. We use it to key in two ways. Yes. Before we get into what it is, let's have a look at this first. What actually is the sequence? So the sequence is where every number is the sum, is where the two numbers before are added together. So 0 and 1 is equal to 1, 1 and 1 is equal to 2, 1 and 2 is equal to 3, 3 and 2 is equal to 5, 3 and 5 is equal to 8, 8 and 5 is equal to 13, and so on. When you put that onto a chart, you get some mad one of these. You might actually see it better. Something like this. But then when you see it and you look into it, you can see it in everything, in nature, in everything, in your hand, in your fingerprint, in your palm, and in everything, in your ear. I think there's an ear. Yeah, there's an ear here. You can see it in everything. Flowers, whatever that is, trees, roots, you can see it in as well. Animals, you can see it in. Space, you can see it in. And it's just a mathematical sequence. But that's what it is. Essentially, it's not too deep that you know all this part of it, but it just that I let you know because it's quite interesting. So when we're looking at the Fibonacci or we're looking at equilibrium, it's called. The main reason we're looking at it is because when price is in a GAN box, that's what I'm looking for. Right. When we're looking at price, 2 seconds, bear with me. Fine, 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 fine. When we're looking at price, you either want to be, you only want to sell price if it's at a premium, and you only want to buy price if it's at a discount. So when price is below 50% of the move, it's at a discount, and when it's above 50% of the move, it's at a premium. So the way to think about it is, if you wanted to buy something in a shop, you might be able to pay full whack for it, no hassle, 100 quid. But if it was on sale, you might be able to buy it for 40 quid or for 70 quid, 30 quid off. But if it was a Black Friday sale, you might just get a better deal on it again. You might get 70, 80% off it. And that's the best time to buy it. So why would you buy it when it's at the top? You'd wait for it to come back down, and then you would buy, and then you would let it do its thing. Why? Because you're getting a better price, you're getting more value for your money. And then the same thing with sellers. Or if you're selling something, you don't want to sell something for the cheapest price ever. You want to sell it for a premium. You want to sell it for the absolute maximum amount of money that you can sell it at. Why? Because that means you profit more. So when we're looking at equilibrium and Fibonacci, this is just essentially what equilibrium is you take a chart. So now that you know below the 50% is your discount zone. So you always want to be buying below the 50%, and you always want to be selling above the 50%. So I'm going to show you how to find the 50% now in a minute. But it's important that you understand you want to sell at a premium and buy at a discount. For example, if you have a fair value gap here and a fair value gap here, which one, and you're in a bullish trend, sorry for the context, which one are you going to take into account? You're going to take into the one at a discount. Why? Because you get it at a better price. If it doesn't come down and reach it, that's fine. That's fine. But odds are, if you're buying it into a fair value gap that's in a premium zone, odds are it's going to be wiped out of the premium zone, and there's going to be a fair value gap below it, and you could get in there for a better price. So now that we know what the that's just equilibrium. Equilibrium is just finding the midpoint between a high and a low of a move. So now if we have a look here, we're in a bullish trend, Ollie. So how do we know we're in a bullish trend? Oh, stop being so slow, man. How do we know we're in a bullish trend? Because price is making consecutive higher highs. and higher lows. Although this is your change of character here, break of structure, we could short term be in a sell a bearish trend. Why? Because if you looked at the last video, bang, there will be your, that's the wrong thing. If you look at the last video, that's going to be your change of character. There's your market structure shift. Market structure shift. And now if we get a break below here, and price comes and breaks below there, that's going to be a break of structure then. But just for argument's sake, and just because it's sitting here in front of me and it's handier to do it here now, we're going to look at price as a bullish trend, and we're going to look at it from this low down here, this swing low, up to this high up here. All right. So when you're in a bullish trend, this is all in the course as well. I'm just going to run through it better because it's just easier to see with a visual. Everything's in the course here now that I'm going to run over, so you can have a look back to yourself. Look at the video, look at the course, and put them together. Happy days. Kula, happy days. Go from the low to the high in a bullish trend. You're going to go from the swing low, and you're going to pull it, your fib, from the swing low up to the swing high. And then you'll see on the Fibonacci, and this is your fib tool, but if we go to our GAN box, so if we get rid of this and go bang and use our GAN box instead, same thing, except the GAN box only gives us the 50% mark. You can toggle it so it gives you other marks as well. I just don't, because I just use 50% mark. That's what I use it for. And if I was using something to get a deeper retracement, I would look for a Fibonacci. So now I'm going to change this back to the Fibonacci. So we know and we understand that when you're selling at a premium, and when you're buying at a discount, all right? Now stay with me. So we know this line here, this white line here, that's your midpoint, that's your 50%. So below that, you're already getting a discounted price. You're already buying price. Once it's below that mark, you're already buying price at a discounted price, which means you're already getting better value for your money than if you were to buy up here. Why? Because you're buying in a premium up there. So you don't want to sell up here, you want to sell down here. Now, this zone here, we know our 50% is our equilibrium, and then we have, remember the way we were talking, you can get something for 100 quid, but if you can get it for 70 quid, brilliant. If you get it for 50 quid, brilliant. But what if you could get it for 40 quid? Or what if you could get it for 30 quid? But that's what the Fibonacci allows us to measure. So if you look at these digits here, 618, 705, and 786. Between the 618 and 786, this is your golden zone. That's why you have it in orange. This is your golden zone, is what we call this. And all this means is, right, this 0.5, that just means that price retrace 50% of the move. 0.618, it means price retrace 61.8% of the move. 78.6, same again, 78.6% of the move. So when we are trading, we don't want the price is never just going to go all the way up, because it always has to come back down to retrace. Why? Because we're talking about imbalances. It always has to fill imbalances, and if it goes up too quick, well, then it's going to leave imbalances, and it doesn't want to leave imbalances. It wants to move. What we're looking for, move evenly, like move cleanly, with clean price action. And all your imbalances and stuff like that, they're not clean price action. That's leaving imbalances in the market for price to come down. Literally, perfect example, for price to come down and fill into. So there's your fair value gap, like we were talking about before. There's your fair value gap on a 4-hour time frame, just about tapped into it. Fine. Bit of order block action going on over here. And then to couple all that together, and come over there, couple all that together, you have the golden zone. Bang. So when you overlap the three of them, would have been an all-the-way trade, except we know from we're only at the scene, market structure shift, change of character, trade is more than likely probably going to go bearish unless you get a break above these highs. That would indicate the price is going to continue to go to the upside, and then this would all just be to fill this imbalance. This is going to be, because if we had to fill this imbalance, see, I'm rambling on now again. If we had to fill this imbalance and then just rally back up, well, then we still leave this imbalance that we're at the tapping into. But now that we've tapped into this imbalance, it doesn't mean that we don't have no reason to come back down unless there's an imbalance or some sort of liquidity or something beneath and where we are currently trading at right now. Now we can use the Fibonacci in a couple of ways. 61.8, 78.6, that's your golden zone. That's the prime area. That means you're getting price at the best, most discounted price. So 50% is good, but I'd rather get 70% off if I can, if I'm allowed to. Do you get me? Do you understand? I'm not going to, I don't want to push it. I don't want to only take it at the 78.6% or 78.6 yet, because I might miss. Oftentimes, and especially with gold, price will come down past the 50% and then rally. So if you're waiting for it to come into this gold zone, you're going to be left waiting. Terrible, because your directional analysis is good again, it's correct, but your what's it called, your trading plan, if your trading plan only allows you to enter out to 61.8 to 78.6, which is what we call your golden zone, and you don't take it, it's kind of a double-edged sword again, because you're sticking to your trading plan, but you're missing out on the trade as well. But it always works out better in the long run to stick to your trading plan, so just do that. These levels here, these can always be used as levels of liquidity. So if we got a retracement based off of this move here, we got a retracement. The fib gives us levels of where price may retrace to in the future. Just going to give you a couple more examples. Slow technology, man. It's going to be the death me. Low, the high, golden zone, reaction. No, I don't think. Yeah, we did. It came down. If you were to use these, I personally don't. But I just personally never have. You could use these as take profit levels. You'd never use the Fibonacci on its own. You'd always use the Fibonacci in alignment with something else. Like, say, for example, you go from this low to this high. You did get a slight reaction off it, but ultimately price came down and then retested this level and then continued to go bearish. Doesn't work all the time, but it's a gem. And it's important as well, if you see a fair value gap, same thing again happened here. Tap in, bit of reaction, and then rally back down. But it all depends on what time frame or what trend you're looking at. So if you're going up, you're going from the low, from the most previous low to the most previous high. And if you're going bearish, well, then you're going from the most previous high to the most previous low. And you can use it against each other as well. Like if you're higher time frame bullish, but you might want to catch a shorter time frame retracement, you can use your fib on a higher time frame to get an area for a retracement to come back into. So see if you can find. Wicks as well. I don't personally take into account the wicks. Sometimes I do. A lot of the times I don't though. Why? Because you might get some bastard wick and it's massive, like huge big wick, like big diddy wick, and it fucks everything up, like it fucks off, it skews everything. So I personally don't. But say for example we were back here and you pulled your fib from this low to this high, and you can see that if we were, so bear in mind that you can't see this half of the screen, can't see my hand either, you can't see this half of the screen. So if we were entered into a sell here, we can say right from this high to this low, we can look for price to retrace down here, look at our Fibonacci levels, and then see if this aligns with a higher time frame, a area of interest, which will be your golden zone, or 50%, or might be disimbalance or order block or whatever it may be. But yeah, that's simply put fair value gaps. Oh, sorry, that's simply put a Fibonacci and equilibrium. Very simple, very easy. Buy at a discount, sell at a premium. Don't sell at a discount. Don't buy at a premium. Simple as that. So we'll leave you with that. Again, like I said this before, if you have any questions, reach out, text me, ask me. I'm not a hard man to find. I'll answer any questions, whatever questions you may have. Somebody else is just afraid to ask, so fire them away. You ask them away, and do your study. Don't just look at the video and think, right, well, I'm after watching him do that video there now. That's buy the discount and sell at a premium, and that's that. Then use it, go in, understand it. The settings for the fib tool are there. My settings anyway are there. If you need them, and all of this is going to be down below. So with that, that's Fibonacci and equilibrium, and I will catch you in the next video.